Glyn, July was another volatile month for equity markets. How would you summarise the mood?
Well, it was a month of really quite high drama, I would say, and I think could prove to be a pretty important month when we look back at 2012 in total. The most of the month, until really the final week or so, was a very nervous period for markets, with the focus again very much on Spain and Italy, but Spain being the real focus. And we had a period where several regional governments in Spain turned to the central government for financial support, getting into some difficulty. Spanish bond yields went through to extraordinarily high levels. And then there was a very important shift at the end of the month. So we'll talk about that in a bit more detail, because I think it was very important. But overall, it remained a nervous month, but markets in the end actually did really rather well by the time we got to the end of the month.
So another month with Europe at its epicentre, both good and bad news. What would be the headlines?
Well, as I mentioned, Spain was the real focus, and we saw Spanish 10-year government bond yields go out to 7.5% at one point, as we had these requests for financial support from regional governments. We know that Spain has already requested a bailout, €100 billion bailout for its banking system. We know that Spain is in deep recession. We know it's going to take a long time to fix those problems. And that was a very, very nervous period for markets. We then had, about a week before the end of the month, a big surprise statement from Draghi at a speech in London, where he essentially said that the ECB will do whatever it takes to preserve the euro. And he went on to say, and it will be enough. The second important thing that he said is that if the rise in peripheral government bond yields has an impact on its monetary policy transmission mechanisms, it is within the ECB's mandate to provide support. So it was a very, very big statement. The market immediately recognised that, and literally within 48 hours, yields on 2-year Spanish government bonds, which had also gone through to 7%, a big worry for the markets, had come down by over 100 basis points. And in fact, further moves since then have resulted in literally a 2-week period, yield on Spanish 2-year government bonds halving from 7 to 3.5%. So I think that was a very, very big statement from Draghi. It indicates that the ECB and probably the Eurozone governments have made a further step in the direction of central support for these peripheral countries.
It's relatively rhetorical so far, though, so we're not out of the woods. What is required? What are the next steps?
No, we're absolutely not out of the woods. What happened is that a few days after Draghi's speech, the ECB then met formally and inevitably disappointed the markets by not implementing secondary market purchases of bonds, by not announcing a full sort of support package. And the markets reacted negatively to that initially, but reading between the lines, it was clear that the ECB had made it clear that provided peripheral countries, and of course they were referring to Spain and Italy, provided they sought a bailout with conditions attached from the Eurozone, then the ECB would be prepared to act by buying bonds in the market. And of course it's the ECB which has all the firepower to be able to do that. It has unlimited funds, essentially, to be able to buy bonds. The Germans have been resistant to that because we know about all those inflationary concerns they've had, but it seems in Germany there's been some moves in this direction. So I think we've got to see now Spain requesting a bailout. It looks as if that will now happen in due course. There will of course be conditions attached. Then the ECB will support the bond markets of those countries and enable them to be funded on an ongoing basis. And that buys time. But of course the ECB can't solve the underlying structural problems of competitiveness and too much debt. That has got to be sorted out over a long period of time. What the ECB can do, and I think will now do, is enable these countries to have some time to do that, and time means a period of years. But it's a further step in the direction of the Eurozone muddling through. Stress followed by intervention. There'll be more stress that will come along, no doubt, but it's a step in the right direction and gives these countries, Spain and Italy in particular, because they're the big ones that are in trouble, it gives them time to sort out their structural problems, and it's going to take years.
On the subject of time and muddling through, how are things in the US turning out?
Well, that's the other big issue, of course. There's concerns about growth in the US, and all the evidence coming out of the US in recent months has been that there's been a marked slowdown in activity. We saw confirmation of that with the Q2 GDP numbers, growth of about 1.5%, down from roughly 2.5% in the first quarter of the year. No big surprises there, incidentally. It's fair to say that the numbers have been a little bit mixed. We had some very good payroll numbers at the end of last week, which has helped markets in the early days of August. But essentially, it seems to us as if the US economy is on a slower growth trajectory. We're now looking at around 1.5% or so, with the private sector actually doing well, particularly in some parts. Housing has picked up. We've seen some evidence of that. We know manufacturing is doing okay, but that's offset by the austerity and of course the coming austerity in the government sector. We know that there's going to have to be some cutbacks, particularly post the election. So it looks as if we're going to get this low growth, slow growth in the US for a period, but some growth. We don't think we're in a recessionary environment.
Turning then to the markets in July, what were the standout features?
Well, if we'd looked at the markets a week before the end of July, it would have looked pretty miserable. By the end of the month, because of Draghi's speech, there was a very big rally. And in fact, the leader was the European markets. Peripheral markets had a sharp rally, although we're still down on the month. The European markets in total were up by over 4% in the month. We also saw credit markets actually doing well, European credit markets doing well. Most markets were up a little bit over the month, MSCI World up 1% or so. And we've now had, it doesn't actually feel like it, because it's been a tough period of high volatility, as you mentioned earlier, but we've now had from early June a 10% rally in the MSCI World Index. So it's been a remarkably good period for equity markets over the past few weeks, although it actually doesn't feel like it.
Going forwards, are there any key changes to positioning or theme that you anticipate?
Well, we're conscious of the fact that equity markets have had a good rally from those lows. We do think this stress intervention cycle that we've talked about quite a lot is going to continue. We are obviously not out of the woods with Europe. We've taken a step and a further step in the right direction towards this muddling through process, but it wouldn't surprise us now if we saw equity markets consolidating a little bit after this decent move. We're mindful of the fact that we've had quite a sharp rise in commodity prices, certain commodity prices in July. The most notable, oil, has bounced back nearly 15%. That's a little bit of a worry. Obviously there are concerns about what's happening in the Middle East and Iran in particular. And then we've had a very, very big move in soft commodity prices, soya, maize and wheat, almost entirely on the back of the drought in the US. But some of those prices are now up 35–40% in a few weeks. We don't think that that's going to feed through to core inflation globally, because there are still big deflationary forces, but it's going to make the job of central banks around the world, who are all in monetary loosening mode, it's going to make their job that much more difficult, particularly central banks in the emerging world. It's something that China is clearly going to be watching. We know they want to be easing monetary policy further, and they did do so in July, but they're going to watch those inflation numbers clearly pretty carefully, so we'll also be watching that as the weeks roll by.
Great. Thanks, Glyn.